Hello all, welcome back to my channel. I'm AsFIN. Today I'm going to talk about the initial public offering and how we can make money from it. In capital markets, there are primary and secondary markets. In terms of stock market, the primary markets are markets where we can get the shares directly from the company. The secondary markets are markets where we can buy and sell shares from the other buyers and sellers with the help of stock exchanges. An IPO is a process by which the private company offers the shares of stock to the public for the first time. So by going public, the company raises capital from the public investors which can be used for various purposes. So if the company wants to expand research or it needs to repay the debt, it can go for the IPO and it can get the wanted money from the public. So on looking onto the initial public offerings, there are two classes of shares, namely primary and secondary. Primary shares are bought by public and institutional investors such as mutual funds and pension funds. The secondary shares are bought by the company's employees or investors like the venture capital firms. So on looking onto the secondary shares, people holding these shares have to wait around 6 months after the initial public offering. So as they would have to wait for 6 months, the people tend to sell it, and because of the long selling, the stock price may go down, and that's the disadvantage, one of the disadvantages of the IPOs. And this is the reason why most of the listed stocks fall within 2 to 3 weeks. So most of the IPOs come with overpricing, and most of the stocks are overvalued during an initial public offering. So if you would like to invest, you would have to look more on the company and its ratios and pricings. In one of the interviews, Warren Buffett has also mentioned his views on the initial public offerings. He said, we have more IPOs, and if you think that people on the other side who would like or have an interest on quoting higher price, they are picking the time to sell to you. But Warren Buffett said, pick the time to buy in 2008, which is the crash, rather than having this time when they have decided the time that they can cash it. Okay, so is there any chance that we can gain profits with the help of initial public offerings? And the answer is yes. So there is another concept called the grey market premium. So what is a grey market premium? So a grey market premium is a premium amount paid at which IPO shares are traded before it is listed on the stock exchanges. For instance, company A fixes its IPO price at $100 per share and its IPO grey market premium is $50. Then the organization will get listed at $150. Eventually, investors will receive up to 50% of profit on the listing day. So the grey market premium is basically the difference between the grey market price, which is in our case $150, and the listing price, which is $100. So 150 minus 100 makes you $50, which is the grey market premium in our example. So if you are allotted with shares successfully, and in our case if you are allotted with say $100 per share, and once it get listed, for example if it is listed tomorrow with the price band of $150, then you can sell it at the same day for $150 and you can get the profit of $50 within a day. So that's basically like a lottery based on luck. So you would have to look on to the grey market premium prices before the listing day, and then you can make profit. So it's up to you and your research and analysis. If you are willing to apply for an initial public offering of a company, you can do it with your favorite broker, and you would have to check with details like IPO date, price band, lot size, etc. I hope this video helps you understand about IPOs and listing gains, and see you soon.